This is the morning brief from the Economic Times.
From the peak of 2007 that saw Ratan Tata scalp the iconic Corus Steel for $12 billion to the trough in 2016, when Tatas were forced to sell a steel unit also in the United Kingdom for just £1. Yes, really £1, to being back on top again in 2022. It's been a remarkable ride for the 115-year-old Tata Steel. And just this Tuesday, it raced past Tata Consultancy Services Limited, or TCS, to emerge as the most profitable company across the house of Tatas for the financial year that's just gone by, or FY22. This is happening for the first time in many, many years. For a manufacturing company beating a software giant like TCS, also known as the cash machine of the entire group, this is no mean feat. It's Thursday, 5th of May, just 2 days from the ET Awards. From the Economic Times, I'm Arijit Barman. You're listening to Tata Steel, hot again on the morning brief. I'm absolutely delighted to have with us a very special guest, a Tata lifer, a numbers genius, a friend, a guide, fellow Bengali and cinephile, as well as foodie, Koushik Chatterjee, Group CFO, Tata Steel. Mr. Chatterjee, thank you so much for taking time out and joining the morning brief. Let me start, considering it's IPL season, and that too, Tatas are the sponsors this time around. So let's start with an IPL analogy. The profit figures for the first 9 months of this fiscal, and if one had looked at that, Tata Steel was already on a steady clip. The gap between Tata Steel and TCS, which historically has been the group's flagship, was narrow. You were at 31,000 odd crores versus TCS, which was around 28 odd thousand crores. First 9 months of the fiscal. But like cricket, often we see teams choke in the slog overs and fail to sustain that required run rate. But this time around, Team Tata Steel hit a maximum. You have beaten TCS with a higher profit for the first time in 14 years. Okay? And that's what my numbers show from a profitability point of view, from a bottom line point of view. If I have to ask, what were the 3 critical things that actually made it possible?
So I think it's not about beating TCS. We are in different industry, in different growth path. It's a global footprint that TCS follows. We are more focused on India and in Europe. I think there is post the acquisition of Europe and Corus, there has been a multi-year transformation process every year, which was not reflecting in the financial outcomes.
Years after Tata Steel went ahead and acquired the struggling Corus Steel in Europe, the Indian giant has finally given up and decided to sell its UK business.
But I think there comes a time when we are more fit for purpose to handle the volatility, vulnerability, and the uncertainty that the steel industry provides to any operator. So over years, we've done huge takeouts on costs across India. We have in Europe, we have looked at working on the efficiency and productivity factors. Year on year, we focus on taking out about between 3 to 6,000 crores of cost in terms of KPIs. It doesn't reflect always because you improve your physical KPIs, your operating KPIs, and then reflect that in money value through standard cost. And obviously, the standard cost changes because you have inflation, etc. But the KPIs keep improving, and the same thing happens in Europe too. Second, I think the integration planning in the recent acquisitions that we have done, whether it's Bhushan or acquiring the steel business of Usha Martin, and we are integration ready for Nilachal too. I think these are the few reasons which, even when we are looking at when we acquired Bhushan, our debt number was over 1 lakh crore, and the focus was to ensure that we need to grow, but we need to reshape the balance sheet. And it has been relentless last 36 months in terms of focusing on cash flows, on profitability, on costs, on working capital, on overheads. And I think so there would be a time when the externalities would be overcome by the internal forces or internal strength. And then there would be time when there are tailwinds when you see that in full bloom.
Correct. But let's rewind to the heady days of pre-Lehman. $12 billion buyout of Corus, and then Lehman happens. The world came tumbling down. We've had several conversations about it, the implications. The company thereafter posted losses in FY13, FY15, 16, FY17. Let me ask you a personal question. What was the lowest point for you professionally?
So I think, personally, I'm less a rider on this emotive cycle. I know I work in this industry, which is a tough industry. So I think I haven't felt actually any low point in those years. I only thought that always that there is a task to be done, and there were a lot of hard calls taken on portfolios, on pensions, getting things right, continue to invest in India. See, those years were also very difficult years for the industry as such globally. And that's why FY13-15 happened. We had huge seaborne Chinese exports, etc. So, those were the difficult years for the entire European industry, difficult years for even in India. And we just kept doing what we know we can do best. And I think that is what drives not only me, but all my colleagues in the company.
But the decision to sell Scunthorpe for £1, that was like a screaming headline. Everyone's jaws dropped. How did you react, sleep at night that day?
No, so again, these were not erratic decisions. These were thought through decisions. I go back to the first principle. Is that the right decision for the long term of Tata Steel? The answer to that was yes. We evaluated and looked at it from all angles. Equally important, I must say that we also worked in a manner where we were a responsible seller. And we didn't drop the keys and run away. We took care of the employees, we took care of other stakeholders, and we understood that we have to trim down the portfolio in the UK given the structural way in which the UK demand-supply situations was working and the customer end, the impacts that they were facing. So it was a structural strategic call, and it was done in the best possible manner.
And then just when things were looking up with this news of a potential mega merger with ThyssenKrupp, again, it went wrong. ThyssenKrupp, the union did not work out, several reasons, regulatory or otherwise. Was that the point when you and your CEO, Mr. Narendran, decided enough's enough, let's fix it once and for all, and let's do it all by ourselves?
So I think that that merger that was proposed, I think, was the right thing strategically to do. Europe needs consolidation of some sort. It could have helped. Unfortunately, it was not the management of two sides or the shareholders of two companies which had any role in play, but it was more a regulatory fallout, which is again extraneous.
Plans to form a landmark joint venture between ThyssenKrupp and Tata Steel have been rejected by EU regulators over concerns that the deal would push up prices and reduce competition. The EU Commission had hoped a tie-up between the two giants would help tackle overcapacity in Europe's steel industry, but it remains concerned about the proposal.
And you don't have all your abilities to handle external outcomes. And we basically said it's not that we would have given up if the merger had happened, because we were 50% shareholders. So we would have been as involved as we were before and after. So I think it was more about then, if this does not go through, what's your next best alternative to pursue the same outcome? And that's what we have done over the last few years.
Now, you talked about Europe, and that's exactly what's given the cue for me to ask you the next question. What's going on in Europe? I thought Asian Games are in China, Football World Cup is in Qatar. How come European demand is firing across all cylinders?
So there are a couple of things which is happening not only in Europe, but across the industry globally. I think we are seeing the impact of a supply-constrained steel industry once China has decided to focus on the internal markets and not play the seaborne trade, which is what had caused the volatility over the last 15 years, honestly. And because at one point of time, China was building capacity of, say, 50, 75 million tons a year. Then it became surplus to their requirements, so they started exporting. And then coming out of the whole climate change initiative or controlling emissions, they are now shutting down and consolidating capacity. I think it's the right thing to do. And secondly, I think the supply constraint is hitting the industry. So that's kind of ensuring that the supply-demand balance is restored. And that's what we are seeing in Europe. And there is, in recent times, the disruption that is happening out of the war, in the unfortunate war in Ukraine. Ukraine and Russia both export a significant volume of steel to Europe. And that's not there. And because of which, the European consumers are starved of steel, which is why you see export of steel, but there are quotas in it. So there are a lot more dynamics that are playing out, but fundamentally demand's a lot more stronger. And Europe has been a leader in the decarbonization pathway. And if you really look at the transition to decarbonization, it involves a significant amount of capex. And wherever there is a capex, there is steel. And therefore, you would find that the demand trajectory in Europe will hopefully remain very strong going forward.
Also, I find it very interesting is that from a net production point of view, Tata Steel Europe has actually scaled down, because you mothballed or you divested some assets, yet your revenues are going up. Is it largely because of what you said, the supply crunch, no steel coming from Russia and Ukraine, therefore margins are going up and revenues are also improving?
So there are two factors in this, Arijit. One is the fact that we have anyway scaled down our portfolio from where we acquired, but that got completed. We essentially became a flat products producer in Netherlands and UK some years back after we sold off Scunthorpe and some of the other facilities. But fundamentally, the point that I was telling earlier, that the revenues have increased, because the mix is better. We had a significant amount of commodity portfolio, which we have value enriched over the years in both Netherlands as well as in UK. And that enrichment in the mix itself produces the additional revenue. And that's something which that's again, as I said, doesn't reflect on outcomes when you have a downturn in the cycle or you have inflationary issues in the industry. But when you really look at it in a stable state position, the value of the mix actually reflects on the revenue. And that's been one of the primary drivers, apart from the fact that in recent quarters, the overall price scenario has certainly improved and restored and consistently remained the same compared to the past.
Back to India, you did 2 acquisitions, actually 3.
Tata Steel announced earlier the acquisition of Usha Martin Steel facility in Jamshedpur for 4,600 crore rupees.
Tata Steel has acquired Bhushan Steel, and banks, in fact, will be getting close to 135,200 crore in terms of this entire resolution.
In January, the Tata Steel arm won a bid to acquire a majority stake in NINL at an enterprise value of 12,100 Indian rupees crore.
Now, everyone's wiser in retrospect, but when it was happening, I do remember the overall commentary from a number of peers was that, look, they're overpaying again, and the cycle is just turning. So, were there any apprehensions midway or towards the end that what if we face a Corus-like situation back in India?
No, not really. I think if so when you look at the acquisition that we did, one is the fact that we had just completed Kalinganagar phase 1. We were working on the phase 2. So we know what a build situation, the complexities, the time, the effort that requires to build a greenfield steel plant or an expansion of a brownfield steel plant. So we knew exactly what are the factors that go into build in the build model. Equally important to understand that there were multiple entities which came up in the IBC. And we actually zeroed on Bhushan Steel because we felt that that's the one that gives us the biggest value, being its location, being the facilities, being the product mix, the downstream portfolio. These assets are not to be assessed on a quarter or 2 quarters. These acquisitions kind of give you the benefit over a life cycle.
Now, I'm going to quote an analyst who recently said, since we have crossed the peak cycle in steel, the price trajectory is downwards. Makes sense, right? Even China will eventually taper. How are you hedging against all that?
So let me first address the hypothesis which you quoted the analyst. I don't think we have peaked and we're not looking at the same cyclical movements, fundamentally because there is a structural change that has happened in the steel world, fundamentally led by multiple levers or features. One is the whole decarbonization, climate change, compliance, which has led to a lot of capacity being closed in China. If you really look at China, it may calibrate down to its own internal capacity, but it is not that it is flooding the export market. And we certainly don't see it now, even as we see as supply constraint out of the Ukraine-Russia situation. So I would generally say that the structural requirements of the cycle in steel has shifted or rebased to a different level. Secondly, the decarbonization initiatives and the cost of carbon in Europe is something which is also triggering higher capex. So with supply being more disciplined and demand being more robust, I think that itself carries a natural hedge across industries. And therefore, we too, as a large market participant, both in India as well as in Europe, feel that the demand conditions will continue to be robust in the near term and in the medium term, and the supply will remain disciplined for multiple reasons that I talked about. And it's a natural hedge taking place. We are getting into more value-added downstream products. We are expanding, for example, our packaging products or tin plate. We are expanding our wire business. We are expanding our tubes business, our coated business, our cold rolling mill business. So I think we are expanding on the downstream, which acts as a hedge against volatility because those are value-added products, which has a value-added premium, and the amplitude of volatility of those prices are much less than commodity end. We are looking at higher and higher grades of steel, which are at the premium end. So I think these are fundamentally the levers.
Okay. How bad is the supply chain and raw material situation thanks to Russia and Ukraine? Coking coal prices, iron ore, etc. Prices are volatile, are rising. So short-term price pressures.
So I think as far as the raw materials situation is concerned, which is primarily coking coal and iron ore, I think coking coal has always been more volatile. It has, especially in the last 6 months, it has because of the Australian climate situation, port issues, etc. We had a very sharp increase in coking coal prices, which went up past $600. I think iron ore, on the other hand, is more abundantly available, but it also has it reacts to the largest customer, which is China. And I think that's what it was happening. So I wouldn't be surprised, to be honest, if there is more volatility in coking coal, though it should start settling down at lower levels.
But at the same time, when it comes to iron ore, Tata Steel does have an edge over other companies to the extent that most of its assets are captive. That is a big relief at moments like this, correct?
So I think Tata Steel in India does have its own captive iron ore and about 25% of coking coal from our captive mines. In Europe, it's completely exposed. So 100% of coking coal and iron ore is based on market dynamics. But on the other hand, as we have our own iron ore, I would also say that as far availability is not an issue, but certainly there are regulatory costs which have increased over the years on captive iron ore, and therefore that has certainly added on to the cost profile.
Okay. Now, are you done disinvesting your global portfolio? And what about simplifying the Tata Steel Group? You still have innumerable subsidiaries, associate companies. Where are we on a simplified corporate structure?
I think we've done a fair bit of simplification. We have taken out a lot of companies, more than 100 entities within the group over the last 24 months. We will continue to look at strategic options. For example, we have bought ferroalloys company, Rohit Ferrotech. And that is something which is working with the Tata Steel mining. Now, whether we keep Rohit Ferrotech separately or merge it is a question that we will have to address very soon, because we need to drive synergy, simplification, and not have entities just for the sake of entities. So it's a bit of an ongoing process. A large part of it has been done, but it's not the end. We'll continue to do so.
Now, I want to understand one thing, Mr. Chatterjee. The management commentary seems to suggest that there will be deleveraging as well as capex. Now, how do you do both? Isn't it always an either-or scenario?
No, so I think, we have what's next for Tata Steel. I think next for Tata Steel is an exciting 10 years ahead. We have now, with Nilachal, 4 large sites. We've got into a new materials business, and therefore we want to expand and enlarge those business, whether it is the business in terms of graphene, whether it is in terms of the other new materials that we are talking about, especially medical materials. So those are, each of them have potential to become bigger and bigger over the next few years. In Europe, working on the decarbonization strategy will be very critical for us, and that's a big area of attention. To your question on deleveraging or capex. I think I've spoken earlier that it is a triangulation of actually deleveraging the balance sheet, returns to shareholders, and investment in growth capex. So it's an optima that one has to drive because it's not one or the other. We have done heavy lifting of the balance sheet, and that's been evident from the fact that we've reduced our net debt by more than 50,000 crores in the last 2 years. We will continue to also invest in our growth capex, and Kalinganagar's expansion to 8 million ton is a priority, and that's going on in full swing. So our vision to build a 40 million tons by end of 2030. So I think these are all very important engagements for utilizing capital in the best possible manner and returning and creating value for shareholders.
Finally, can you summarize the future of Tata Steel in just 3 words?
Well, I think it's opportunities, excitement, and hard work.
It was the summer of 2007, and I still recall the press conference the morning after to announce India's largest acquisition ever, Corus Steel. Ratan Tata himself took to the stage, but the Tata Steel stock was tanking. Investors skittish about the high leverage his group was taking on to buy a company which was 4 times its size. A former colleague of mine asked him, "Mr. Tata, is the stock market getting it all wrong? Misunderstanding the long-term strategic intent?" I do not exactly remember the answer, but for 15 long years, Tata Steel has trudged with a mission in hand. Pressure in Europe, leverage, drop in demand, Chinese dumping. In between, some even went on to describe the company as a basket case, as homegrown peers like JSW Steel edged past as the number 1 private steel maker in India. It goes without saying, the company has learnt the hard way. The initial heavy-handed strategy backfired even in their greenfield plant in Kalinganagar, Orissa. Today, the steelmaker's turnaround 5 years after it posted an annual loss is a testament of resilience. It also shows that for a group like the Tatas, it is important to invest in both the old as well as the new, in manufacturing as well as digital. It's a fact that steel is riding the commodity cycle, and most companies in similar industries are at their record highs. But a decade of fiscal prudence is indeed paying off. Finally, while TCS, like most software exporters, generate a lion's share of its business from outside of India and has not bought a single company in the past 7 years, as the management has only looked at organic expansion, Tata Steel, in comparison, has focused primarily on the domestic market, upped its steel capacity by nearly 10 million tons a year in the past 4 years through acquisitions and greenfield. Atmanirbhar, huh? You've been listening to Tata Steel Hot Again on the Morning Brief with me, Arijit Barman. Thank you, Mr. Chatterjee. Deeply appreciate. This episode was produced by Surbhi Modi from ET and Varun Kapahi from Awaz. Sound engineers Swati Joshi from Awaz and Indranil Bhattacharjee from ET.
Executive producer, yours truly.
We hope you liked this episode. Do share the episode on your social media networks. The Morning Brief drops every Tuesday, Thursdays, and Fridays. Thank you, goodbye, and good luck. All clips used in this episode belong to their respective owners. Credits mentioned in description.